back to 2011 for the US bond market as the 10-year Treasury yield reached the highest level in almost 7 years during yesterday's session. This morning, it holds above 3%. Without any clear catalyst, the sudden move in the bond market has the attention of investors who will look to the Fed for guidance on rates in the United States. Now, we heard, of course, from San Francisco Fed President John Williams over the past 24 hours, who weighed in on the rate path.
The center of the distribution has either 3 to 4 rate increases as appropriate for this year as a whole, and a few more increases over the next few years. Now, I personally view this to be the right direction for monetary policy.
There we're hearing from the Fed there, of course. Now, Peter Fitzgerald, Global Head of Multi-Assets at Aviva Investors, still with us here on set in London. I've got this nice chart I want to show you, and this is all to do with whether we see the curve invert over in the United States, Peter, and get your thoughts. This is inverted by the summer. I suppose there could be a question mark in there, couldn't there? If we carry on at current rates, this analysis suggests that the 530 spread could turn negative by August or by September. Do you think that's going to happen? And secondly, I suppose, if it does it matter? Does it still tell us the same things that it used to?
Yeah. So first of all, to go back to one of your other comments, which was, can we get some guidance from the Fed? I think we've had so much guidance from the Fed over the last number of years that, quite frankly, kind of enough is enough in a way. You need markets to find their own pricing. In terms of bond yields and whether they invert or not, our base case is that they don't, and that you will see a rising yields not just at the 2-year point, the 5-year point, but also further at the curve. And I think if investors actually look back at what's happening in the economy, what's happening to unemployment, what's happening with an unexpected fiscal stimulus, because let's face it, we did not expect a fiscal stimulus of this size in the US at this point in the cycle, we think it's completely a central scenario to expect 4 rate rises this year and 4 next. And if you think that long-term neutral rates in the US are somewhere between 3.5 and 4, we don't see any reason why that Fed rates can't actually go there.
Peter, I've got 2 things to tell the world. One, it's raining in Dubai. This is history. The end of May, and it is raining. The second thing is, would you buy a few more dollars? Look at this. This is the correlation. The correlation of dollars to rates. It's turned positive. We've actually flicked it all the way around from Q1 into this Q2. Do you think the dollar goes higher on higher rates? Are you a buyer of that story?
So at the beginning of the year across our portfolios, we were net short the dollar in reasonable size. And throughout February and March, we moved from a short position in the dollar to a long position in the dollar. The question that you have to ask yourself is, what's a shorter term move, and what do you think is the longer term secular position for the dollar? Shorter term, we see the dollar moving higher. Longer term, you've got to have real questions over the fiscal imbalance that's been created in the US and the twin deficits that are emerging.
Okay.